Everyone.
Okay.
Welcome to the course of Management of Insurance Services. Today, our focus will be on Unit 1 of the course, which is Introduction to Insurance. So, in this unit, we shall focus on briefly introducing on the topic insurance. We'll quickly overlook the evolution of insurance in India. We'll understand the concept of insurance as a whole, and also we need to understand that how does the contract of insurance look like. We will study the different principles of insurance, the different types of insurance which are existing in today's scenario. We'll also understand very briefly what is reinsurance and the different types of reinsurance, as well as we'll briefly look into what is retrocession. Now, the term insurance is very familiar to each one of us. So, it is nothing which has evolved overnight. It is something which has been carried forward since so many decades. So, insurance it has emerged from the humanity's fundamental need of security and risk protection. So, every human being is concerned about his or her own security. Every entity should be secured. So that is where the term insurance is connected to it. So now insurance has become an integral part of the entire global economic activity, which keeps industries operational and somewhat resilience. So it has its root which tracks back to 3000 BC. Now earlier also Chinese traders, they used to distribute their goods across multiple boats to minimize the total loss. Like suppose one boat doesn't or drowns, then or it is stolen, the other boats are there so that they can have a secure. So that concept, the security concept, is not that it has emerged in today's scenario. So it is coming from several decades. The Babylonian merchants had paid extra premiums to cancel loans if their shipments were stolen. So that this is a concept of risk transfer. So they had predicted that suppose their ship gets stolen earlier, then for that to have the security, they had to pay the extra premium. By the 7th century AD, Greeks formed benevolent societies to support families and cover funeral costs. So, like they had a group or cohort where they had pooled some funds, and anyone had any sort of necessities, they took out funds from that particular pool. So, this concept is also which we can link to insurance. So, what we can infer is that insurance is not a pretty new concept. It is a very old concept which comes from way back from 3000 BC. So here in this insurance contract, there is an insurer and there is another entity which is known as insured. Now an insurer is a company. You can see here the insurer is a company designing, promoting and selling the insurance products and services amongst the public. So insurer is the company, and the insured or the policy holder, it is another entity or a person who purchase the insurance products or services for his own safety or risk purpose. Now the study of insurance incorporates the discipline of risk management, which acts as a driving force. Suppose we forecast or predict any sort of risk due to uncertainties in future, then the insurance plays a vital role. So it incorporates the discipline of risk management. Insurance is defined as a form of risk management primarily used to hedge against the unforeseen risk of contingent losses. So it is just when we forecast something unforeseen will happen in future, so for that unforeseen or loss, to make up that loss in future, we go for a insurance. Another definition of insurance is the equitable transfer of risk from the possibility of occurrence of losses from one entity to another. by the method of diversification in the exchange of a premium. So we are transferring the loss that we predict to face in future from ourselves to some other entity, that is the company. But the company, for that to make up that loss, the company is taking a premium what we need to pay to the company, so that in future, if any unforeseen circumstances occurs, then the company will be able to make up our loss. As a result, the ramification of a large and devastating loss can be minimized to a greater extent. So this is overall an introduction to the concept of insurance. Now let us very quickly look upon the history or evolution of insurance in India. As we already have discussed, that insurance is not a very modern term. It has its early references found in Manusmriti, Yagnavalkya, and the Dharma Shastra and Kautilya's Arthashastra also. So where they have instances where they have resource pooling for the calamities. Like you predict that some natural calamities is going to happen in future, or some war, something is going to happen in future. For that, from beforehand, you have some resource pooling activities, so that during the time of war or certain type of natural calamities, they were pooling they were taking out or pooling resources to manage themselves during the natural calamities. So, ancient evidence of marine trade loans and carrier contracts. So, the traders in ancient India also, they used this tool in order to like, that means they gave some more amount, as we discussed now, that we give a premium. So earlier it was not termed as a premium, but they had given a more certain amount which is more than the loan amount, so that their loss can be made up. So that is an evidence from the marine traders. There was a strong influence drawn from these foreign insurance systems, especially in England also. So in 1888, the Oriental Insurance Company in Kolkata, followed by Madras Equitable in 1829. Several Indian companies emerged in the late 19th century, but foreign insurance maintained a dominant presence. The early 1900s saw the first attempts that regulatory oversight, starting with Indian Life Insurance Companies Act in 1912. So the first statutory regulation, this we need to remember, that the first statutory regulation, the Indian Life Assurance Company Act, came into force in the year 1912. Subsequently, in the year 1928, the Indian Insurance Companies Act passed to collect data on life and non-life businesses. So we will discuss separately what is this life and non-life businesses. After that, in 1938, the Insurance Act enacted for comprehensive regulatory control. In 1950, the Insurance Amendment Act abolishes the principal agencies, and subsequently in 1956, the life insurance nationalized. The public sector company Life Insurance LIC was found, absorbing 245 insurers. LIC holds the monopoly till the late 1990s. After that, only so many private companies or other general insurance companies came into picture. Now, general insurance roots trace to the British. In 1850, the Triton Insurance Company was established in Calcutta as the first general insurer. General insurance, that means those companies which provides insurance to the different assets, or maybe the properties or house or machineries, that comes under the purview of general insurance. In 1907, Indian Mercantile Insurance Limited established, covering all the classes of the general insurance. Subsequently, in 1957, the General Insurance Council was formed to frame fair practice and codes. And in 1968, the Insurance Act was amended. The Solvency Margins and Tariff Advisory Committee was introduced. From 1971 to 1973, the GIC was formed, the general insurance business was nationalized, and 107 insurers merged into National, New India, Oriental, and United India. These are the general insurance companies. Subsequently, in the year 1993, the Malhotra Committee was set up to reform the insurance sector, and this is one of the milestones. In 1999, IRDA was established as a autonomous regulator for the insurance companies. In 2000, the IRDA became the statutory body and the market opened for private players. Foreign ownership up to 26% were allowed. So this was we can say the globalization for the general insurance companies in India. Insurance governed under the Insurance Act 1938 and IRDA Act 1999 was a federal subject. So this is about the evolution of insurance in India. Two things are here to be noted: the nationalization of LIC, which was in 1956, and the formation of GIC, General Insurance Council. It was in 1971 to 1973, and subsequently the IRDA, the regulatory authority, which came into existence in 1999. Now let us understand the concept of insurance with certain principles and about the contract. So an insurance contract promises to make good to the insured a certain sum in consideration of a payment in the form of a premium from the insured. So insured is the person who, it can be any company, it can be the person himself, it is the insured. So insured, and the insurer is the company who is taking the, or who is to whom the loss is transferred from the individual person to the company. So now in an insurance, it is an agreement or a contract where the insurer promises to pay the insured the amount of loss which he is likely to face, with certain amount of premium which is paid by the insured to the insurer. So he has to pay some amount of premium, which is, you can, like a commission sort of thing, which has to be paid on a regular interval to the insurer, so that the insurer can guarantee safety of that particular property or life, what the case may be. Insurance products available for life and non-life are many. So as we discussed that there are life insurance policies, there are general insurance policies. So it can be the life of a particular individual, or it can be the insurance of any machineries, or it can be the insurance of any property. So it can be both life and non-life. In non-life, apart from personal covers such as accident covers and health insurance, there are products covering liabilities under a particular law or a common law. So life insurance products provide a definite amount of money to the dependents of the insured. In case the life insured dies during his or her active income earning period, or becomes disabled on account of an accident causing reduction or complete loss of his or her income earnings. So this is the concept of life insurance. In case of life insurance, suppose the person who has the life insurance, suppose in case of his death, his dependents, the wife or children, the dependents, they are liable to get the amount of money which is sum assured, which will be reflected in the form or the contract when the contract is signed. So it is not only in case of death, but suppose there is the person is disabled, or suppose the person has faced some sort of accident which leads to any reduction in his present income or earning, then also he is liable to get the sum assured. But again, it depends on the terms and conditions which are mentioned in the policy. An individual can also protect one's old age with when he ceases to earn and has no other means of income by purchasing an annuity product. So there are varieties of insurance product, and this is one of the type of insurance product that one can also secure one's old age. So the person goes on paying premium till a certain particular age or till a number of years, and beyond that number of years, after his retirement, the person goes on receiving the amount, maybe every month or maybe the lump sum he can receive from the insurance company. So that is also one type of insurance which a person can undergo. In respect of insurance relating to property, there are many products which are available. Property can be covered against fire, perils of nature including flood, earthquake, etc. So suppose a building is there, the building can be insured against fire happening, or it may be insured against any sort of natural calamity. Machineries also can be insured for breakdown. Goods in transit can be insured under a marine cargo insurance cover. Suppose, let us assume that a person is bringing his assets, or maybe he is bringing, manufacturer is bringing the goods from a faraway place, and some accident might occur in transit. So there also that person can undergo a insurance for that particular that goods, so that suppose some unforeseen situation incur, then they will be able to make up that loss. Like this is also very familiar to all of us, a motor insurance policy. If we purchase a bike or a car, so an insurance policy is attached with the price of the bike or a car. So the motor insurance policy covers the third party damage as well as damage to the vehicle. So these are the different types or varieties of insurance, which can be life insurance or which can be non-life insurance. So insurance of property is based on the principle of indemnity. Now what does this indemnity means? That means the insurance company will provide the loss which has been incurred by the person or the insured in case of loss of any of his assets which he has already insured by the insurance company. That is the principle of indemnity. The idea is to bring the insured to the same financial position as the insurer was before the loss occurred. Like suppose the loss is 10 lakhs rupees, then the insurance company will provide the insured person with 10 lakh rupees. So he is now in the same position, financial position, as he was before. That is the principle of indemnity. So it safeguards the investment in the property. Where there is no insurance, losses can ruin a project or an industry. So general insurance offers stability to economy and to the society. So like suppose, let us take an example. Suppose a factory. Unfortunately, there was a short circuit in the factory, and the factory is set on fire. The entire factory is ruined or destroyed. So now it is impacting so many, of course the company as a whole, so many workers who were working there in the factory. So now this insurance, the concept of insurance, undoubtedly it is safeguarding the investment of that property. So this sets the entire economy in somewhat a stable condition, the insurance concept. So if we define this insurance, insurance is in actuality a social vehicle for spreading the risk of financial loss among a large group of people, thus making a loss manageable for any one person of that group. So here what they do, they have a pool of premium from different people, and when the calamities or when suppose certain unforeseen situation occurs for a particular person, then they are able to help that person to make up his loss from that pool of premiums which they have received from different policy holders. We will discuss about this in the subsequent slides. Now, moving on to the importance of insurance. Insurance provides economic protection against unexpected losses to individuals and properties. It supports social security goals outlined in the Article 41 of the Constitution through life insurance, especially for old age, sickness, unemployment, and disability. It ensures the inclusion. That means the insurers are mandated by the government to extend benefits to economically weaker and unorganized sectors. You might have heard about different insurance schemes which have been announced by the government with very nominal fees of, let us assume it as 30 rupees, 50 rupees, or 100 rupees by the schemes which have been floated by the government. These are basically mandated to serve or have a benefit for the economically weaker sections. It drives the national economic development by mobilizing household savings, especially from middle and lower income groups. So, this when the middle income group or lower income group people, they are giving a premium from their income. So, it is a kind of force saving for their from these people, so that they can somewhat safeguard their future to a certain extent. So insurance, the companies, they channels the long-term funds into safe, productive investments, primarily government bonds under strict provisions of the Insurance Act and the IRDA Act. So now insurance companies, what they do, like there are, suppose let us assume there are 1,000 people. Now 1,000 people, they are paying premiums, they are policyholders, and they are paying premiums to the insurance company for, let us say, for different agenda points. Like someone will have LIC, someone will have GIC. So there will be different premiums which are pooled by the insurance company from different policyholders. Now, when there is a pool of funds available with the insurance companies, the companies cannot keep the funds idle. So now the companies, what they do, they invest these funds into on the productive investments, which are primarily the government bonds, which are risk-free assets. So they are investing in those type of government bonds, so that the funds of the people or the policyholders, they are safe, and they can be timely. The losses can be made up if there is any need or requirements of the policyholders. So the money is invested in safe, risk-free government bonds. Now let us understand the mechanism in which the insurance company, the scheme runs. There is a mechanism of risk transfer, theory of probability, and law of large numbers. So based on these theories, the entire circulation that is done by the insurance companies, which it rotates within these rules or theories. Now, insurance is a complex mechanism, and it has in it two fundamental characteristics. So, first one is transferring and spreading of a risk from one individual to a group. So, now as we discussed, that when we are receiving funds from different individuals or different policy holders, but at one point of time everyone is not facing some sort of unforeseen situation. So when there is a pool of funds available with the company can is in a position to make up the loss of one particular person or few persons who are undergoing certain unforeseen situations. So it is here the risk is being transferred or it is spread, sharing the losses on some equitable basis by all the members of the group. Now, what happens here when the premium are given by different groups? So that means everyone is sharing their own premium to the insurance company. Let us understand this with an example. Imagine that there is a community where there are 1,000 houses, and each house cost rupees 1 lakh. And let us assume that each of the house is prone to catch fire. They have a risk of catching fire. Now, everyone has the probability of catching fire. Each of the house has the probability, but it's not mandatory that each of the houses will be on fire. So while a very few houses may burn, it is highly unlikely that all will be destroyed. If all the houses will not be destroyed and all the houses will not catch fire. Now, the as a premium, the house owners, let us assume that they agree to share the loss. Like suppose it is burned in future, so what they will do? They will be the policy holder of insurance companies. So and they will contribute. Let us assume that they contribute 100 rupees each for their house. So when they contribute 1000 house owners, if they contribute 100 each, that is equitable contribution, which is premium as we say. If they contribute 100 rupees, then it becomes 1 lakh rupees, which is the covering of full loss, which is the cost of one house. So what happens here? No one single owner carries the burden of the entire loss. The burden of loss is distributed across different groups. That means all 1000 owners are carrying that burden. So this shared risk mechanism reflects the core principle of the insurance. So it is from that premium only they pay or make up the loss of the uncertain events. The next theory, as we discussed, is the theory of probability and law of large numbers. Now, as in the previous example only, we discussed that there are 1000 houses, but not 1000 houses will will catch fire at one point of time. Yes, each house has the probability, but all the houses will not catch fire at certain point of time, and if they catch fire also, all the houses will not burn at one point of time. So insurance operates on the idea that while individual events like a house catching fire seem random, their occurrence follows predictable patterns when observed across a large population. Like suppose we take the example of diabetes. Now every individual, you see every one or suppose there are 4 persons, you will find 2 persons having is a diabetic. So it is a pattern which it has observed. Similarly, while fixing up the premium, the insurance companies, they study the pattern of occurrence of such events. Suppose earthquake. How often earthquakes happen in, let us assume, in a particular in Odisha? How it will in Odisha, how frequently the earthquake occurs. So there the insurance companies has to predict the pattern. And suppose the earthquake occurs also, then what is the severity of that earthquake? So for that, they are going to see that pattern only, and then they are going to assess what should be the premium of that type of policies or schemes which they are offering to the policyholders. That is known as the law of probability. So probability helps the insurers estimate how likely an event is to occur. When the number of insured people or assets becomes very large, these predictions become more accurate. So suppose we see that every 2 years or every year there is an earthquake, or every year suppose there is a cyclone which is happening in Odisha, or let us say in South. So that is a predictable pattern. Yes, every year in the month of around October, November, the cyclone, we can predict a cyclone. So when the number is large, when the sample size is large, then the prediction becomes more accurate. When we have very rare occasions of the unforeseen situations, then the prediction doesn't have much of accuracy. So this is the law of large numbers. Random events show consistent measurable patterns only when the sample size is big enough. So out of this, by predicting the pattern of the unforeseen situations which incur in with the individuals or in that particular area, they try the insurance company, they try to come set the fair premiums, they try to manage risk effectively, and they try to ensure the financial stability. Now let us move on to the agreement or the contract of insurance. So a contract of insurance is an agreement between two parties. As we have already discussed that there is a insurer and there is a person who is insured. So it is enforceable at law where one party, the insured is the person or the entity which is insured. The entity or the insured person agrees to pay a sum of money either in a lump sum or in installments in the return of a lump sum to be paid by the other party, the insurer, on happening of the event. So the insured pays money in installments, that means premium, or he may pay in a lump sum in a particular interval, and the insurance company or the insurer pays a sum assured in case an event is happening, in case of the insured event. Suppose it is mentioned that we are insuring against fire. So in case there is fire, they will provide the lump sum amount, which is a sum assured to the insured person. The following are the requirements of a life assurance contract to be legally valid. So these are the things which has to be there in a contract to be legally valid contract. First one is offer, acceptance, considerations, capacity to contract, insurable interest, utmost good faith. The additional requirement for general insurance contracts are indemnity, surrogation, contribution, and proximate costs. So we will understand this one by one. Now this offer is a proposal or the scheme which is offered by a insurance company, that is an offer. So now all the detailing of the entire scheme has to be there mentioned in the offer. There must be a definite offer, that is a proposal to do or abstain from doing anything. The proposal form completed by the proposer is by law the offer. That means the proposer here is the insured entity or insured individual. So offer is given by the insurance company. So now insurance company will give a form which with all the things which has been mentioned there, and the form has to be completed by the proposer. Proposer is the person or the individual who is insured. So offer is the scheme which is offered. That means the entire details about the contract, which is to be safeguarded, which is to be insured, and what is the sum assured, what is the date, what is the premium, everything will be mentioned in that offer. Next portion is acceptance. For emergence of the contract, the offer must be accepted in express or implied terms and must be communicated to the person making the proposal. So proposer, as we understand, proposer is the person who signs or gives the consent that yes, he is agreeing upon all the terms and conditions, the sum assured, the premium amount, everything which has been mentioned in the format of the proposal. So acceptance means it is nothing but a consent which is given by the proposer, that is known as acceptance. So offer is made by the insurance company, acceptance is done by the insured person. Another term which is associated with this contract is consideration. Consideration is nothing but the premium which is given by the proposer or the insured person, and the sum assured which is assured by the company or the insurance company, that is known as the consideration. So consideration is the act or promise offered by one party and accepted by other as the price of the other's promise. That means one is paying a premium, that is a promise that I will pay a premium of this much amount every month for the policy which I possess. And insurance company also promises that a sum assured of, let us assume, 10 lakhs, 15 lakhs, 20 lakhs will be paid after a certain period of time, after a certain time period upon payment of the this much number of premiums. So this is known as consideration. So consideration consists of some profit or benefit accruing to one party or the other. In the case of insurance contracts, the premium is the consideration in return for the sum assured, which is the consideration on the part of the insurance company. So consideration in the part of the insured person is the premium, consideration from the part of the insurance company is the sum assured. Now, the other term which is associated with the contract of insurance is capacity to the contract. Now, who are the persons who can actually accept the offer? We have just now read what is an acceptance. So, which are the persons who have the capability to accept the offer? So the minors who are below the age of 18, they do not have and do not have the proper maturity of mind. They cannot manage their affairs, so they cannot sign a contract. The person of unsound mind, they cannot sign the contract. Legally disqualified persons such as criminals, insolvents, or bankrupt persons. An insolvent person is one whose liabilities exceeds his assets and who cannot satisfy his creditors in full. So such type of persons, they are disqualified to sign the contracts. Any person who is in intoxication or drunken people during the period of intoxication are temporarily incapacitated, as they tend to lose their mental balance during that time. Now there are few countries which are declared as our rivals. So if our countries declare another countries as enemy country, our citizens cannot enter into contracts with the citizens of that countries. So these are few types of persons who are not liable to sign any sort of insurance contracts. This is as per the Indian Contract Act. Now let us understand the different principles of insurance which are into the insurance contract. The first principle is insurable interest. Very simple. If we understand this, insurable interest means some asset or something will be insured, because there is an insurance company, there is an entity who is going to be insured. Now, insurable interest means the asset or the entity which is going to be insured, that should have a significant meaning, so that the loss of that particular entity will have a severe impact on that individual. So, suppose it is a life of a person, of a earning member of a family. So, when you are insuring that life, of course, you are safeguarding the family's interest. Suppose there is a building, or there is a factory or machinery that has a value and whose loss will definitely affect the other individuals. So that is known as insurable interest. So insurable interest means that the assured must be in a legally recognized relationship to what is insured, so that he will suffer a financial loss on the happening of the event insured and should benefits from its existence. If the life of a person is gone, then it will have an impact on the family of the wife and the children. So that means the life is an important. So, and you are owning, the person is owning that life. And in case of that loss of the life, there will be financial loss. Similarly, in case of a house, suppose the house is on fire. So that then what will happen? The person will face the financial loss, or the person will have no place to live in. So he is in relationship with that particular entity which he is insuring, and it will definitely benefit if he has the house with him. So there must be a property, right, interest, life, or potential liability capable of being insured. So any object which is being insured should have that meaning in one particular individual's life. Such property, right, life, etc. must be the subject matter of insurance. Subject matter means it is life, or let us assume it is a vehicle, let us assume it is a property. So that is the subject matter, which is the principle of insurable interest. The insured must bear a legal relationship to the subject matter whereby he stands to benefit by the safety of the property, right, interest, life or liability, and stands to lose by any loss, damage, injury or creation of the liability. That means the person who is taking use, the policy holder for the insurance of a particular entity, should have a legal relationship. That means suppose I am having an insurance for the house, that means I should be the owner of that house. I should have a legal relationship, or I should be the owner of the vehicle for the vehicle for which I am getting the insurance. Next principle is utmost good faith principle. The term means in complete agreement of mind. That means it is mutually the insured person and the insurance company, both of them come to a same platform that both of them should be trustworthy, and they are not hiding any such facts from each other. So the term in complete agreement of mind, in any contract the parties must be ad idem of the same mind. Ad idem means that both of them are of the same pace and of the same mind. The proposer must disclose. Proposer is the insurer. Is the insured. Proposer is the insured. That means the person, that means the property which is being insured. Suppose the vehicle which is being insured, the proposer is the insured and insurer is the insurance company. Here the proposer, suppose I am a person who is highly diabetic, or I am a person with a very high BP. So if I don't disclose it to my insurer, then it will be difficult for them, or it will be it will be unethical on my part, and so that I am hiding my facts. So it is affecting the premium of a particular person. So the proposer must disclose all material facts known by him to the insurer. The Marine Insurance Act 1906 describes a material fact. Thus, every circumstance is material which would influence the judgment of a prudent underwriter in fixing the premium or determining whether he will take the risk, and if so, on what terms of condition. Suppose a person who has already had an attack earlier and he does not disclose that fact to the insurance company. Now, if he discloses the fact, of course, it will have an impact on fixing the premiums or the risk aspects. So, the utmost good faith principles states that both the insurance company and the insured person should should disclose all the types of facts which are related to the scheme, as well as which are related to their own property on which they are getting the insurance. The principle of indemnity we have already discussed. Indemnity means compensation for loss or injury sustained, or security or protection against loss or damage. Insurance contracts promise to indemnity, that is, make good the loss or damage. That means suppose I have lost 5 lakhs worth of the property, then the insurance company will pay me 5 lakhs rupees. That means I am still having my same financial status. That is the principle of indemnity. So they are limited to the actual amount of loss. That means if I have lost 5 lakhs, I will get the 5 lakhs. It's not that I will get 6 lakhs or 8 lakhs. So they are limited to the actual amount of loss or damage subject to the sum assured. For example, if a house is worth 5 lakhs is insured for rupees 8 lakhs, and if it is sold during the period of insurance, so no payment is made because there is no insurable interest after the sale of the house. Now suppose the house has been insured, but again it has been sold during that period, then there will be, the insurance company is not liable to pay the insurance amount because the property has already been sold. But suppose the house is destroyed with some natural calamities, then the insurance company will pay 5 lakhs, which is the actual worth of the house, to the insured. This is the law of indemnity. The law of subrogation, this means, this is a principle. Sometimes what happens that there are number of parties from which you are insured. Like when we talk about subrogation, subrogation is the insurer's right to step into the shoes of the insured after paying a claim and recover the loss from the party which is legally responsible. So now let us take an example to understand this. So so it arises only when the insured has suffered a loss, and this exists another, and there exists another party who is legally liable for that same loss. Like the insurance company also will pay for the loss, and the other company which is also liable to pay for the loss, because that loss has happened due to the negligence of the other company, not because of the insurance company. Insurance company is there because it has sold the policy to the insured, but there are other companies due to the negligence of which that loss has happened. So now here both the companies, the insurance company as well as the company for which the loss has happened, both the companies are liable to pay for that loss. And why this exists? It ensures the insured does not recover twice for the same loss. So this type of principle, subrogation, it exists because now suppose a person insured, he will also claim from the insurance company, and he will also claim from the company which is responsible for the loss. Then for that, to avoid those sort of recoveries, this subrogation principle is applicable. The insured chooses to claim from the insurer. After paying the claim, the insurer takes over the insurer's legal right to recover from the negligent third party. Now let us take an example. Suppose this house is on fire and there is a damage worth of rupees 5 lakhs. But the house was on fire was due to the plumber's negligence. So now the company from which the plumber is hired, that company is also liable to pay that 5 lakhs rupees of money. So now if the insurance company pays that 5 lakhs to the individual, then the insurance company has the right to recover the amount from the company from where the plumber has come and due to which the negligence has happened. So that is known as the principle of subrogation. Another principle is the principle of contribution. The core principle is that contribution, as we understand that contribution is the amount, that is the premium or the sum assured by the insurance company. So contribution ensures that when a loss is covered by more than one insurance policy, the insured still receives only one indemnity, not multiple payouts. So suppose a house, it has been insured, or life, suppose I have multiple life insurance policies. So when I have multiple life insurance policies, I cannot claim the insurance from all the 3 policies. But yes, of course, I will claim my insurance in proportion from the different companies. The insured may claim from any insurer in any order, even recover the entire loss from one insurer alone. Now suppose these 3 companies, as the example here, there are 3 insurance companies and the sum assured of 3 companies are different. Like suppose one insurance company will pay the entire loss, then the other 2 insurance companies will recover the claim from the other companies. That means suppose C has paid the entire loss, 18 lakhs rupees. So now C is at loss. He has not claimed any insurance sum assured from A and B. Now A and B will recover, the C will recover the entire amount from the A and B. But it is in the proportion at which the insurance has been done. So once one insurer settles the full claim, that insurance gets the right to recover a proportional share from the other insurer. This right activates only after the insured loss has been fully indemnified. Suppose C has completely indemnified the loss, then C is liable to recover that proportionate amount of loss from A and B company. To avoid the imbalance, the insurers insert contribution conditions. Like in this case, suppose there are three companies. One company's sum assured is 9 lakhs, the other company is 12 lakhs, and the third company is 18 lakhs. Total amount of loss is 3 lakhs 90,000. So A is liable to pay 90,000, and this is the formula. Sum assured of A is 9 lakhs into amount of loss is 3 lakh 90,000 divided by total sum assured of A plus B plus C, 3 lakh 90,000. So A will pay 90,000, B will pay 1 lakh 20,000, and C will again pay 1 lakh 80,000. So this is how you can proportionately claim from different insurers. So this contribution principle is worthy in case where you have different insurance companies for a particular claim. Proximate cause. The fundamental idea is a loss is payable only when the dominant effective cause of loss is a peril covered by the policy. So every policy should have mentioned that what are the different causes which it will cover. Like suppose the policy, it will be mentioned that it will cover the death claims of that person. This is one cause. Suppose second cause is it will cover the accident incurred, and if suppose the person is permanently disabled, that can be one of the cause. Or suppose it will mention that it will cover the accident and it will also cover if the person is temporarily disabled. So the policy should have the causes, proximate causes, the logical causes which should be reflected in the offer which is made by the insurance company to the insured person. If the efficient cause is an unasked peril, the loss is recoverable. If the cause is good enough and it matches to the offer, then of course the company will reimburse the claim which has been given or which has been applied by the policyholder. There are different types of insurance like life insurance companies, general insurance companies, standalone health insurance company, and reinsurance companies. So when we talk about life insurance company, we have already discussed that these are insurance companies which sell life insurance annuities and pension products. So if suppose in case of death claims, the life insurance company will pay, or there are also schemes which takes care of the pension of the individuals. Like suppose you go on paying premium for a certain period of time, and after that period ceases, you will start getting, after your retirement, you start getting annuity, some lump sum amount of money at every intervals that you start receiving as your pension. So there are 27 life insurance companies in India registered with the Insurance Regulatory and Development Authority, which is DAI. Similarly, there are 34 non-life insurance companies operating in India, which includes 6 public sector companies. And this is also registered and regulated by IRDAI. And there are some companies which only has health insurance. So presently there are 6 companies transacting in healthcare business in India. Like these are very popular, all of you might know. This is Niva, Bupa Healthcare Insurance, Star Healthcare Insurance, which is very popular. So there are very few companies which only concentrate on health insurance, and there are companies which are reinsurance companies. Reinsurance companies, we can say that these are the companies which provide insurance to the insurance companies. So these are insurance for the insurers. So the insurance companies, when they provide safety to the individuals for their loss which they are predicting in future, they are also having to face some sort of uncertainties in future. So that is why that their money also needs to be insured by a separate company, which is known as reinsurance companies. These are few examples of reinsurance companies: Aqua General Insurance Limited, Agricultural Insurance Company of India Limited. These are few reinsurance companies. So, reinsurance is a transaction in which one insurance company indemnifies for a premium another insurance company against all or part of the loss that may sustain under its policy or policies of insurance. Like suppose a company is an insurance company and it has suddenly paid 1 crore of rupees as insurance to a particular factory. So now the reinsurance company might have already insured this insurance company with a certain amount of premium which is paid by the insurance company to the reinsurance company. That means it is a double insurance. In a reinsurance contract, one insurance company, the reinsurer or assuming insurer, charges a premium. The reinsurance company will charge a premium from the insurance company, which is the primary insurer, against all. That means 100% he is going to insure or some proportion. Suppose it is insuring only 50% of the entire amount which is being reinsured, which the insurance company have invested or which the insurance company had given as a claim. So reinsurance contracts may cover a specific risk or a broad class of business. Reinsurance is a global business. Its international nature reflects a further spreading of risk and access to broader capital markets. So reinsurance is in emerging trend now, but it is likely to grow in future also. There are varieties of reinsurance types like reinsurance treaty, facultative reinsurance, and hybrid reinsurance agreements. So in case of a reinsurance treaty, it is like the entire coverage of the, as I said, 1 crore, the entire amount will be insured by the reinsurance company. But when it is a facultative reinsurance, that means case by case. Certain cases might be reinsured, certain cases might not be reinsured. And here in case of hybrid, there will be a mixture of both facultative and the reinsured treaty. So if we talk about the retrocession means if the reinsurer feels that the risk is too large, then he can also buy reinsurance from other reinsurers. So there is a third layer of reinsurance company in case of a retrocession. So there is an insurance company, a reinsurance company, another there is a retrocession. So we come to the end of this unit 1. Thank you.